Gold, meantime, has been a pretty messy trade over the past few months, but it is bouncing back today. So let's get straight to Sharon Epperson at the NYMEX with today's action. What are we seeing, Sharon?
Mandy, we started the year with gold prices near $1,700 an ounce, and now it looks like gold may be headed back in that direction. We are looking at a nice rally today in the gold market, up over $20 and above $16.75 an ounce. This is key, and a lot of it hinged on the fact that we saw that rally in the euro, dollar weaker, this after ECB President Draghi's comments, and also on that positive trade data we got out of China. But gold still pales in comparison when you look at something like platinum. The platinum group metals have been on fire this year, and we're looking at the ratio between the two at about $40. That's the tightest it's been since April of last year. So where is gold headed? Well, a lot of folks are looking at the 12-year bull run in gold and saying, yes, we're likely to see another bull run for gold this year, but it will be from a slightly lower base. We're looking at Barclays' latest report saying they see it at $17.78 an ounce. That is below where they had the forecast in December. A lot of firms ratcheting down their price forecast, but still saying it's going to be a strong year for gold. Back to you.
Sharon, thank you very much. Well, gold was higher last year, but it was the smallest yearly gain for gold since 2008. So is this the year that gold finally rolls over? Let's bring in Mike Vogelzang, president at Boston Advisors. Mike, gold up or down this year? What say you?
Oh, it's going to go up. We're positioned that way. We expect to see higher prices of gold. Sharon's right. Gold's rolled over a little bit over the last few months, and with decent reason. We've seen the 10-year move up. Right, real interest rates have become less negative. India. There's more rumors about taxing imported gold in India, higher taxes rather. So there are a couple of things that are beginning to slow down the sort of freight train that gold's been for the last decade or so. But we think there's some real positives. We don't think that. I'm certainly not betting against a bigger Fed balance sheet and competitive devaluations around the globe.
And if it does go up, Mike, how much is it going to go up? Where will it end the year?
Well, it wouldn't surprise me. 1750, 1800. I mean, it wouldn't be a huge surprise. Right now, guys, the sentiment on gold as an investor class is pretty negative. It's about as negative as we've seen it. And that usually has a pretty good indicator of saying, we're going to see a decent short-term pop anyway.
I find it quite difficult, though, to try and work out exactly what the driver for gold is. Because remember, there was a time when it was considered the ultimate safe haven, right? Safe haven against inflation, safe haven against geopolitics. We don't have a huge amount of geopolitical problems going on right now. And, I mean, okay, you might feel there's inflation, but the CPI doesn't say there's a real inflation problem. You can believe those numbers if you want. So what's the main driver? Is it a currency inverse trade? I mean, what is it?
Yeah, I mean, we look at gold as I think the easiest way to think about gold is as a store of value against feckless and reckless central bankers around the globe. I mean, it's not that complicated. Nobody can print additional gold. Nobody can buy bonds denominated in or sell bonds denominated in gold. You can't generate more than the typical 2, 3, 4% kind of growth rate you see in the gold supply. So as a result, it's clearly thought of as a currency, at least by some in the investment community. And I think that's the simplest. Gold has been going up against every currency for the last 10 years. And that's a direct result of we think, central bankers losing sight of what they're supposed to do, and that is to maintain a consistent and stable monetary supply.
Mike Vogelzang, president of Boston Advisors. Mike, we'll get you back on soon. Talk about it. Thank you.